Madeline's joined us from Denver, Colorado. So she got up a little earlier this morning. We'll thank her for making the time. And then we got some folks from all over, folks in Illinois and Florida, Massachusetts, New Jersey. And so again, thanks for giving us some of your morning. We'll try our best to do a better job than the weatherman did forecasting the storm that didn't materialize here in New Jersey, but preface this by saying, again, forecasts are a tough part of this business. And so the idea of today's discussion hopefully will be a lot about recapping 2022 and giving you some insight as to what we see so far in 2023 and the outlook thereafter. We'll give you a more formal agenda in a moment. But again, we'll bounce back and forth a little between both Madeline and I from a standpoint of presenting. A little bit of background for the discussion today. Again, Breakwater was launched in June of 2022. So we're a little over 6 months in existence here. Thank you for those who've decided to partner with us. We're managing now presently about 120 families in 16 different states and a couple institutions as well. The content today is more broad-based. A lot of this will apply to each individual participant, but specifically this shouldn't be construed as advice or recommendation solicitations. Those conversations we're happy to have on an individual level. So just doing the fun disclosure part over the years, I'm sure you've seen plenty of those things. Also want to just give a lot of credit to the sources. We grabbed information from a host of different parties, some of which we are able to share. Some of them, unfortunately, we can't. We'll share in the context of the seminar today, but we'll be able to actually send you the specific slides just per their requirements. With thinking about today's discussion, we'll try to make these a quarterly event, right? Periodically pull in some one-offs. I was joking with a friend of mine, and Madeline did a ton of work with preparing this. The markets are so fluid these days. What ends up on a slide on Monday ends up being pulled off a slide on Tuesday. So we're trying to be as timely as possible, especially for the stuff in 2023. But bear with us because some of that stuff could change by tomorrow. So Maddie, I'll let you kind of kick off today's discussion in terms of the agenda, and then we'll dive right in.
Great. So we're going to start. This is our agenda for today's meeting. We're going to start with what we think happened last year, how that's affected the economy, move into how that's subsequently affected the markets, and with what we're doing about it in terms of an asset allocation conversation. And the Secure Act 2.0 got passed, so we'll review some highlights from that as well. First up is the economy here, and Jeff will kick us off.
Yeah, so tomorrow we'll get the much-awaited fourth quarter GDP number. The average estimate from economists is about a 2.5. This will come off after a 3.2%, which is the final reading for third quarter. Again, that firmly describes the fact the U.S. economy is expanding. I'll be expanding a little bit less quickly than the third quarter. To the right is the slide from the Atlanta Fed. They run this GDP Now forecast, which I've actually kind of check out on a not daily basis, but pretty regularly during the week. It's kind of a real-time Fed forecast, a real-time GDP forecast. The accuracy there is mixed. Tends to be directionally right, although the actual absolute level can be a little squishy from week to week. But again, if you look at where we ended the year, and some of this I think was reflected in the markets, we'll talk about a little bit, was on a generally positive note, and we're hoping to see some of that continue here in 2023.
And if we look at that hard data compared to the soft data in terms of surveys of, not only consumers, but this is looking at it from more of a business perspective, you can see here that these indexes following periods where businesses don't feel strongly about the economy here. Typically, we're in a period of these red lines are US recessions. And so you can see here that it's dipped before in the past between 2012 and 2018. We haven't seen a recession from that, but larger dips have been typically correlated with US recessions. Same thing here on the right. But hard data is pointing to the economy not necessarily slowing down as much as these surveys would assume here. And you can see that this is it's very similar graph, but looking at consumer expectations of the economy rather than businesses. So you can see here we've had severe dips followed by, typically US recessions, but again, that hasn't always been the case. If we
I'd come over the top a little now, and just for a second too, like, so when we talk about hard data and we talk about soft data is just like anecdotally getting, kind of the feel from survey participants. And it's not uncommon where you have people say one thing and actually in real time seeing something different. And so manufacturing is a very interesting one. So last month, for the month of December, we saw the ISM manufacturing print beginning this month that showed signs of contraction. Yet, if you actually looked at the labor data for December and the non-farm payroll report, manufacturing a place where you saw hiring. So the truth is the manufacturing numbers or picture is probably better than what the survey is telling us. And you can see that firsthand with automobile manufacturers and Boeing. Like Boeing's got a 5-year backlog. So the Fed's focusing on the hard data. The soft data gets a lot of headlines, but I would say focus on the hard data more as signal and soft data a little bit more as noise. Sorry, Maddie.
And if we look at, what's causing that, inflation has, been the number one talked about thing, certainly last year. So if we actually look at where inflation has come from, this is breaking it down by sectors. Headline and core inflation. Headline, of course, includes energy and food. And so we saw that peak in June of last year at 9%. You saw the energy sector get hit somewhat hardest by inflation, peaking in June again at 7.5%. What's interesting here is you can also see that energy has come down. The green, obviously the red is where inflation has been hitting hardest. As you move more into those green colors, you're seeing where inflation is coming down the fastest. And you can see that between gasoline and electricity, inflation has actually come down pretty significantly from its peak in June, whereas it's been a lot stickier for core goods and core services that you can see here at the bottom, like rent, food. Those things have been significantly stickier than gasoline or electricity.
Yeah, and the rent one in particular, like if you live in the tri-state, I know folks on the call today who are in Manhattan, a lot of the concern about, the camp that said inflation was going to roll over was worried about this concept. Well, housing still is pretty expensive, pretty sticky, but we've actually seen the OER, or the owner equivalent rent numbers, show some signs that maybe the back half of this year will decline or moderate. So as we get to these kind of lapping events, as we start comparing Q2 and Q3 of 2023 versus Q2 and Q3 of 2022, that should actually, you start to see some lighter green in those numbers there as well on the bottom.
And if we look at how that translates to global inflation remains high given lingering supply chain disruptions, labor shortages, and certainly has been exacerbated by the war in Ukraine, which has sent commodity prices, pretty much sky high and had rippling effects around Europe. Yet inflation in emerging economies, which is this lighter blue line here, has been relatively stable, even despite the rally in the US dollar. So somewhat encouraging from an emerging markets perspective. It looks like, if we look at emerging economies, which we'll talk about a little bit later, making up more and more of the GDP numbers, that would tell us that inflation, may have peaked globally. And you can see that here from the numbers on the right. Russia's inflation numbers is 12%, probably no surprise to anyone there, the highest of anyone on this list, whereas India and Brazil are a little less than half of that number.
And it's important to acknowledge, like, Brazil's dynamics are, it's a country that actually is a big exporter of commodities, oil and soy and whatnot. So that the ability to locally source has been able to allow them to contain prices a bit. And then India and China have both benefited from continue to absorb Russian inventory of oil and to a lesser extent gas. Russia has been, very much impacted by the massive decline in the ruble, and so that's somewhat noisy on the back of sanctions. The next slide is to kind of continue on this theme, but what I think is somewhat interesting here is really everyone was worried about this significant spike in inflation in the Eurozone. And while they are still dealing with higher inflation, so I'm going to go, it's not necessarily going to be as bad as forecast. Some of it was the ability to bring on natural gas supply. Some of it's the benefits of a warmer winter. So far, we've been very much fortunate. There's been a bit of wind at our back on the inflationary story. And so if global inflation does dissipate, it gives the Fed, central banks more broadly, cover to slow their tightening process. The ECB and Christine Lagarde, who's the ECB chair, has indicated they tend to be a bit more hawkish than the U.S. This year, but at the same time, they're coming from much more or much lower absolute levels. So collectively, again, this suggests that maybe the peak of tightening, right, not necessarily the absolute peak level of rates, may be very well behind us as well. This is my kind of slide. I'm just I enjoy semantics a lot, right? So like transitory, in my mind, is still something that could be very well 2 years, right? Now, I know like Jay Powell has been very much beat up in the press for choosing that word, and I'm sure he regrets in doing so. But what you're seeing here is basically the 1970s, which is the line that goes from completely left to right. And then overlaid on that is the more recent 2014 to 2022 timeline. And so there are some similarities to the inflation spike you saw back in 73, 74. But you can see that the long-term trends in inflation, in the 70s and the early 80s saw inflation, well north of 5% pretty consistently. That seems unlikely to be something we would repeat. We'll continue to monitor the situation. There are going to be some short-term effects that could contribute to a little bit of a head fake where inflation might tick back up. That could be reopening China, so on and so forth. But I think it's the middle part of this graph might be the absolute peak, and the idea that we get back to something resembling where we were in the last 10 years seems much more likely. So I still think transitory is an appropriate word. It just gets back to what your definition is.
And if we look at the longer-term view of US inflation, previous surges in inflation were associated with unique events, some of which lasted for years. More active monetary policies have been in place since the early 1980s. And although it's uncertain whether the ultra-aggressive Federal Reserve actions can contain inflation in the near term, in the past, higher inflation, obviously, as you can see from the numbers, have been correlated with weaker markets and economic gains. You can see this Goldilocks period, so to speak, here during the Great Moderation, not including Iraq or Afghanistan, not a period for war and free flow of money left the markets and sort of, like I said, that Goldilocks period. So that's the hope. It'll be remain to seen if that'll actually come to fruition here. We were in this 4 to 9% range for inflation changes over year to year, hopefully getting back down to this 1 to 4% range where you can see positive returns from the market and positive GDP numbers.
Yeah, remember the 80s and 90s saw a period of consistently higher interest rates, yet the U.S. economy expanded and the stock market did quite well. So higher interest rates in an absolute sense, or more sticky higher rates, aren't the worst thing for markets. It's the rate of change, right? CPI or change of inflation year on year. And so when you have those big jumps, it's to be expected that things need to be adjusted. Asset prices are one of those. So what's creating this disinflationary effect? So we all know that in 2020 and early parts of 2021, we seemed like we were locked in our homes. Not necessarily the same way the Chinese actually physically locked people in, but people made a collective choice to, shelter in place, right? Working from home became the new normal. So people were buying homes or expanding their homes, buying appliances, PCs, so on and so forth. And so as we saw that massive demand for goods, it translated to a big spike in prices of those goods and also a significant increase in the cost of transportation. So freight, which is again rail, you saw the prices spike very much in the back half of 2021 and early 2022, and they've totally rolled over. Trucking or transportation also has seen a pretty significant decline, not necessarily in the same relative basis, but those are good things as it relates to moderating the cost of goods. There's still some challenges, of course, to work through here to get back to where we're, back in pre-pandemic days. But directionally, again, the decline in transportation costs is a positive, and that's just simply augmented by lower fuel prices, both gasoline and diesel as well.
And now moving on to the Federal Reserve and the labor market. So we've seen higher rates. So this is a graph showing you of what the federal funds rate has been. And you can see here that it's peaked over 6% in the early 2000s, again in 2006, And we may be slowly creeping back up here. This is where the federal funds rate is expected based off of what the Fed numbers have been thrown out there. That's the blue line. The market expectations is in green here, and longer run projections are at that 2.5% here. So the Federal Reserve is, planning to be a little more hawkish than the market is expecting. The market has already sort of digested these green rates here. So, if we do get above that 5% mark, it's not something that we haven't seen in the past. Again, we saw it back in 2006 and we saw it early in 2000s. Essentially what that means is that, unemployment rates definitely will go up, but hopefully inflation won't be as sticky.
Yeah, I think the dot plot, right? The statement of economic projections the Fed does every quarter. It's like close while they watch TV, right? And so, in addition to providing both, the idea of where they anticipate Fed funds, right, and 5.10 is their most recent projection. They also do some forecasting around where they think unemployment will be, right, at the end of this year, at the end of next year, as well as where they think inflation is going to be. So if you look in the box within the chart in 2023, you can see they expect GDP to run around 0.5% this year. So again, anemic, but growth nonetheless. Unemployment to move up from today roughly 3.5% to 4.6%. Now I'll come back to that in a moment. And then the headline PCE, which is their preferred measure of inflation. Well, actually, the PCE number this Friday, they expect that number to be back with a 3 handle, so 3.1. And then into 2024, the economy reaccelerates, so GDP jumps back up to 1.5%, roughly speaking, 1.6. Unemployment stays constant, right? That's like a really bizarre one, right? Like the idea that you have a higher unemployment rate, but that stays kind of in lockstep from one year to the next. I believe it when I see it, and then inflation continues to trend down. Look, they have to put these forecasts out there. People watch them closely. The good news is they don't get fired necessarily when their forecasts are accurate, but the market, which is the kind of wisdom of crowds, tends to be a little bit more dovish. Their expectations are probably for a 25 basis point rate hike this coming Wednesday, February 1st. Another hike is really kind of a coin toss right now in March, and the market's basically done there. The Fed will tell you they're going to raise rates at least in both February and March, and possibly again in May and June. So, and this to me is kind of where Jay Powell's job is really difficult. There are some politicians and won't name names here who've been pretty good on the bully pulpit, basically saying, hey, the Fed is willing to accept some damage to the economy, and that's short-sighted, right? You're going to tell people that no, you're willing to allow them to lose their jobs because it's great it's better for the greater good. And we know unemployment in general is a bad thing for society as a whole, and for the people individually impacted. These things can have generational impact. But if you look at the slackening in the labor market, there are some encouraging signs, right? So one is we've seen the JOLTS, which is job openings, trend down, right? At one point, there were 2 job openings for every available worker. That was back in August or so, July, August last year. It's now down to 1.7. So yes, you're still in a better spot for looking for work today than you would have been in previous times, but it's not necessarily as challenging an environment for employers to find people. And again, that shifts the balance of power back from labor to capital. The participation rate is also an opportunity. You can see that the Bureau of Labor Statistics has a trend line that suggests that that number is going to, hop back down to a lower level. That's just demographic driven as we see baby boomers, continue to retire. But you can see where we were pre-pandemic with the participation rate, north of 63%. Today we're just a little over 62. So the capacity for another 1% of the working age population, which essentially amounts to about 1.8 million people, are available labor, whether or not they come back when their pandemic spending has been exhausted, or pandemic stimulus is exhausted, or if the pandemic effect, which does, I know, still impact a number of people, has less of a psychological impact on behavior. So we're watching that closely. Labor is probably the biggest driver of long-term inflation, more than any sort of supply chain or demand spikes. So again, labor is if you're going to spend any time on looking at hard data, spend a lot on labor coming forward.
And
transition to capital. Oh, sorry. Go ahead, Maddie.
Now moving into Jeff's favorite topic, the market.
It is my favorite topic, at the expense of trying to be thoughtful, we probably culled a list of 75 slides down to about 10. And again, I can send you some of the stuff, but I'll try not to exhaust the entire audience over the next few minutes. This is a really cool slide, right? So to me, you look at where the market is on the basis of history using different valuation metrics. So the most common shorthand is the good old-fashioned PE ratio, which has its limitations, right? If you're a business, it actually behooves you to limit what you show in earnings because earnings translate to taxes. But by and large, again, if you want to use that as historical guide, stocks today are not inexpensive. They're probably a little above fair value when you look at history. The forward multiple as of yesterday is about 17:1. On the basis of price to cash flow, stocks actually look a little bit more inexpensive, and that kind of gets back to this idea of how companies are pretty thoughtful about gaming their earnings. Like Amazon is a great case in point, and this isn't a specific case for a company individually, but Amazon uses Warren Buffett's model of pay little or no taxes if you can. So if you value Amazon and price to earnings ratio, you're talking about a stock that trades at 60, 70, 80 times earnings, although actually very well might have a negative PE or a zero registered PE if they show a decline in earnings and actually a loss for Q4. But on a price to cash flow basis, that company or a number of companies actually trade at a much more attractive valuation. You can look at some other interesting indicators, right? Like the rule of 20, which is an old Peter Lynch, which used to take the number of 20, subtract the rate of inflation, and that ultimately is where the market should trade. Well, again, inflation running at 6%, and 20 less 6, we can do that math, is 14. Knowing that we're at 17.1 suggests we're on the higher side. The Fed model, just kind of comparing stocks versus bonds, suggests that stocks aren't as unreasonably priced, largely because interest rates are still low by historic standards. So long and short of it is it's a mixed picture. The thing I could say to you, and Maddie, I'll hop to the next slide, is it's easy to say that we've seen a material improvement in valuation from where we were this time last year, and that's on the back of an 18.1% decline in the S&P, right? Earnings held up last year. We saw modest earnings growth. We're likely to see something similar this year. So if earnings are flat and prices down, markets get cheaper, right? We like to have as stocks go up, earnings go up faster, and markets stay cheap. So the question in 2023 is, what happens to earnings, right? So we're in Q4 earnings season as we speak. We have had a number of companies report. We'll talk about that in a minute. But the expectation is that companies for the last 2 or 3 years were what you refer to as over-earning, right? And over-earning is a byproduct of excess demand, tremendous amount of pricing power. And so that meant higher margins, right? Margins, and I know this is an eye chart, margins in 2021 were as high as 13%, 14%. They're going to come back closer to the long run average, is about 11. And so it's safe to assume that there's a little bit of an impact profitability on companies, primarily in the form of higher input costs, specifically labor. Again, I still think you'll see earnings growth this year, probably roughly in the mid single digits, and that's on the back of just top line. If inflation this year still averages 3%, and they go back to the Fed's GDP forecast of 0.5% of real growth, that means top line should see growth anywhere from 3 to 4%. So earnings should grow this year, just probably not likely the 10 or 15% we've seen in prior years coming out of after a soft year. So we'll hop to the next slide, and this gets into kind of the real time detail with respect to earnings.
So in Q4,
so this, yeah,
sorry.
So other than my typo on the bottom, so this is data as of yesterday. The S&P has seen 14% of their constituents report. Earnings were down 7.5% year on year, right? So comparing Q4 of 2021 to Q4 of 2022. And some of that's very easy to explain. A lot of it's a byproduct of financials having tougher year on year comps. If you remember, fourth quarter of 2021, you had still the investment banking business was booming. You had a little bit of volatility in the markets, which are good for the trading business. So again, I think this is a little bit of a narrow window to look through. But in the top line, companies are beating about 65%, which is below the 5-year average. That's still healthy. And then on the EPS level, about 70% of companies are beating. We'll see a lot more over the next 3 or 4 days. Today actually happens to be a day where I think it's something like 60 constituents of the S&P alone were reporting. And so we'll over the course of the next couple of weeks, we'll get a lot more visibility into how earnings are shaping up and how that really impacts the future. So yesterday, just a bellwether stock, Microsoft, had reported better than expected earnings. So their EPS beat, but their guidance was soft. And so we're looking at that thematically. If say, hey, look, you beat your top line, you beat your bottom line, but at the same time, your guidance is weak, we're going to look at the next quarter as a show me quarter. The forecast for the fourth quarter collectively is about a decline of 4.6%. The market generally tends to beat those estimates. Analysts tend to lower the bar so that companies can look favorable. So the absolute number for fourth quarter earnings are probably a decline of between 2 to 3%. We'll hop to the next slide. So I know firsthand I've been impacted by this with respect to clients, right? I've had some phone calls that have been uncomfortable for the last 2 or 3 weeks, as we've seen announcements of job losses at Goldman Sachs to Alphabet and Salesforce, so on and so forth. And so it's interesting, when you see that stuff, you assume that, wow, that must mean business has deteriorated markedly, and it's foreshadowing something really on the horizon that could be ugly. But what's interesting, if you actually look back at pre-pandemic headcount, and these are just 3 or 4 of the FANG stocks, Facebook, as we are more accustomed to referring to the company Meta Platforms, doubled their headcount. Literally, they went up 100% over the course of that time frame. Alphabet, the parent company Google, went up roughly about 60%. Amazon almost doubled as well. So while the headlines are, because I'm eye-opening and frankly for those impacted, a significant story, we are actually seeing some resilience in hiring. There's a piece today in the Wall Street Journal about small businesses, very much still active, grabbing talents. A lot of these tech workers who have been impacted have easy to be absorbed in the workforce. And then Walmart, I think now second largest private sector employer. I mean, the federal government is the largest employer in the U.S., but Amazon, I think, might now be a little ahead of Walmart, but Walmart announced yesterday not only intention of hiring more, but increasing their minimum wage. So it's a mixed bag out there. We'll have to watch and monitor what happens on the headcount side, but it's a very easy opportunity for companies to improve margins, but can have some short-term adverse effect as they take charge. Like Microsoft took a fairly decent sized charge as they accounted for severance expenses.
And if we look at how that translates to consumer confidence in the stock market, this is the subsequent returns of the consumer sentiment index here, which has been splashed around the headlines a lot. And so as you can see here, when consumer confidence is low, it tends to be good for stocks. So since it's low right now, it has ticked up over the past few months. This is where it sits as of December of 2022. We may see subsequent positive returns in the market. Surely that's not saying that, through 8 sentiment troughs here, that as you can see in this box, the subsequent return of the market has been on average 25%. We're surely not suggesting that the market is going to go up by 25%. We'll talk about expectations later in this piece here, but we think that it's surely going to be better than last year, following maybe somewhere in the 6% range here.
Yeah, look, the interesting thing in a lot of these other past points and sentiment troughs were oftentimes the sentiment was driven by the actual recession, and the Fed's response to that recession was to cut interest rates. We know that's not the case today, but if interest rate moderate or interest rates do come down, maybe not as aggressively as they have in the past, it generally tends to be a good thing for asset prices. And we'll talk about that in a minute. Now, I have a mixed crowd. Not everyone is as optimistic as I am or Madeline is in the long run. And so, some people say the what ifs, right? And we'll get to another what if at the very end. But it's safe to assume that if, in fact, inflation doesn't moderate, doesn't come down in a more meaningful way, stocks are too expensive, right? And so this is a pretty cool slide. At least cool in terms of the amount of data, not necessarily cool in terms of the numbers, but they're looking at the idea that if inflation is in a certain range between 4 to 6%, PE should be around 15 times. If inflation's like really sustainably sticky between 6 and 8%, multiples should be closer to 12%, right? Well, knowing that the S&P today is at 17, on a fair value basis, again, depending what happens with earnings as well, you could talk about the stock market being anywhere from 10 to 20% lower. Again, that is not our base case by any stretch of imagination. You have to be willing to acknowledge that there are different opinions out there versus being anchored to your own. So again, kind of an interesting way of thinking about this from the standpoint of where inflation is in the long run. If you're in the camp that it's going to be stickier or higher, it's hard to rationalize equities at the current level.
And if we look at different US equity sectors in the economy, so recovery, early cycle, expansion, mid-cycle, slowdown, late cycle, R is that recessionary period where everyone is probably most familiar with because it's what the news covers the most. These are the 4 different phases of the business cycle. They tend to have different sector performance leadership that you can see here at the bottom. But no 2 business cycles are the same. So future sector leadership is certainly likely to vary. So this is something that gets splashed around a lot. It definitely is helpful, certainly not something to live by, but this is something, as we rebalance portfolios, certainly something that we take into consideration.
Thanks, Maddie. One other quick thing I'll wrap on with the market, both in the past quarter or even the last year and the current quarter, is the amount of distortion and concentration in the market. So we know last year the S&P average end of the year down 18.1% on a total return basis. So that's price decline plus add back the dividend. And so when you really unpack that, you look at what was the driver of that poor performance, right? And so we'll get into some of the specifics there in a second, but the best sector everyone seems to know is energy, right? The worst sector for the year was consumer discretionary, which is where Amazon finds itself. But if you really get into the 5 or 6 biggest stocks, right? Apple, Microsoft, Alphabet, at the time, Amazon and Facebook, those stocks average a decline of about 40%. If they accounted for roughly about 25% of the market, which is close to where it was, so that's 22.6, 25, depending on those numbers you look at, those companies alone accounted for about a 10% decline in the S&P. So stripping out those names, it wasn't quite as bad of a year. Now, this isn't trying to spin or anything, but it also is, again, if you look back in 2020, when the market was up 16, 17%, really is on the back of those companies, right? So this is kind of a little bit of that, hey, I rode a wave on the name on just a handful of names, and now I rode the tide back out on a handful of names. And what we've been trying to impress upon a lot is when we think about the business cycle and investing, if we're smart enough to know where momentum is going to take us in the next best sector, then super, we'll write you a check. It's really hard to do that. And so it just gets back to we'll probably own at any given time all of this stuff and have some marginal biases in places where you think the risk return looks a lot better, specifically on the valuation basis.
And now as we move away from US markets into global and international markets, we'll start with China.
Yeah, so everyone's favorite topic, right? There's not a day goes by when people don't want to talk to me about why they don't want any overseas exposure. Although last year, overseas stocks actually did well by comparison. This year, just to give you a quick update through yesterday, the S&P was up 4.7%, the NASDAQ up 8%. The EFA index, which is basically Europe and Australia, and Japan, was up 8%, right? So roughly neck and neck with the NASDAQ. And emerging markets were up 10%, right? So, being invested overseas thus far year to date was a good thing and very good in the fourth quarter. And some of that is built up on the euphoria or the excitement about the reopening of the second largest economy in the world. And the question is, what is the China effect, right? Is it going to be purely a positive, right? As they, find their ability to manufacture more iPhones and consume more products from U.S. multinationals like Nike and Starbucks, who've been impacted by people being locked down, or will you see a more significant inflation uptick as they consume more oil and industrial metals, as they have in the past used infrastructure spending as a big source of stimulus. So it's a to be determined. I have some real reservations with China as an investment itself. Doesn't mean that I don't own it or we don't have it as an exposure or client's portfolio, but I think it's safe to assume that at an index level where China accounts for about 30% of the emerging markets, that's a little bit more than I'm comfortable with, largely because of just a lack of willingness to participate in the capital markets in a traditional sense. We saw in the last few years, some pretty aggressive policy around the technology companies like Tencent and Alibaba, and to a lesser extent, or excuse me, to a greater extent with like for-profit education, where they essentially wiped the businesses out. It's not all about China, right? It's, Europe is the second largest, actually, you could say it's the largest economy when you amalgamate all the countries, excuse me, in the economic region. And so everyone was writing their post-mortem on 2022 and thinking about 2023 with the expectation we'd see a recession in Europe. And it seems that, at least in the near term, they might very well be able to avert that. That would be a positive for sure. They also benefit significantly from the reopening of China, where they're massive trade partners. The manufacturing in places like Germany and the Netherlands, are consumed quite a bit in China. And at the same time, Chinese travel is a popular source of revenue for the continent. The UK won't be so fortunate. And despite the fact that UK market, which actually was positive last year, distorted by big companies like Shell and BP, the economy there is in a really bad spot, right? The impact of Brexit continues to weigh on policy, relatively high, not relatively, absolutely high unemployment, coupled with just a sticky inflation there makes for a challenging environment for the UK. So that's a place that we're a little less constructive on over the course of the next, probably 2 or 3 quarters at minimum.
And if we look at comparing valuations globally, so you can see here that the US in red is still, relatively overvalued compared to that of a lot of different other emerging market economies. And so, many markets have more attractive valuations than the US market. Again, this is a case for, more global diversification and making sure that your portfolio is properly diversified from a global perspective.
Yeah, and so the next slide does a really good job of getting to the numbers, right? So the S&P, on the left side says that the PE ratio is 16.7. It's actually closer to 17. This was done at the end of last year, and we've seen the market go up a little bit. So at 17 times, you're above the 15-year average, post GFC or a little bit in with the GFC in there. So you're buying stocks for fair price, right? And if things go smoothly, you'll do just fine in the US. In the Europe, right, you're buying stocks at a discount to the long-term average, right? You're buying from roughly about 10%, relatively less than what you normally would, but 72% less than what you pay for US equities. And yes, I think it's a very safe statement to say they should trade at a discount, right? There's much more innovation, there's much more entrepreneurial spirit here in the US. Tax policy is much more favorable, but at what level is that discount too big? And the emerging markets, where in the past you had to deal with much more of a kind of a geopolitical instability, and that exists in places today. We see it in Peru and Sri Lanka and others. But the big players within the emerging market landscape, other than Russia, like Brazil and India, and to some extent China as well, have much more stable political outlooks. Certain instances of the past which have been kind of find your religion moments, like the late 90s, have created a much more thoughtful approach to policy, specifically around capital flows and whatnot. And so you're buying emerging market stocks at a much larger discount, really at 70 cents on the dollar. So it's safe to assume they belong somewhere in the portfolio. Maybe not anywhere near the same as your equity weighting in the US, but enough. Howard Marks is a great quote. And I'm gonna just read it off my notes just to try to paraphrase it. It's not what you buy, it's what you pay for it that determines whether something is a good investment, right? And so, I'd come back to say, like, you can, always find yourself being rewarded if you bought something at below its intrinsic value, and I think that seems to be the case for overseas investments.
And if we look at this from a global consumer sentiment, so essentially, this is a replica of the US graph just from a global perspective. So if we look at 4 sentiment troughs here, 2003, 2009, 2013, and 2020, we saw relative stock market increases of about 30%. Again, certainly not suggesting that that's going to be the case here. You can see that sentiment has ticked up over the past few months, but certainly low consumer sentiment means a turning point in the market. So we would expect that moving forward. And if you take a look at, the impact of international emerging markets growth, emerging markets now represent a larger share of world GDP, which is what these pie charts are breaking down here, furthering the support of diversification. So if we look at back at 2008, emerging markets made up 31% of world GDP. If we look at that in 2021, now they're making up 41%, so a 10% increase. The US has remained stable. We went up 1% from 23 to 24, but the advanced economies, not including the US, have shrunk pretty significantly, at about 9%. So, if we're looking at this again as the engine for growth, it makes sense to have some exposure there.
Yeah, it's interesting. So this picture to me years ago, like the US counts for 5% of the global population, but 25% of GDP. That means 75% of GDP exists outside the US and 95% of the planet. So it's safe to assume that we will probably not be the same engine for growth that we've been in the past, and even this last decade showed that, or last 13, 14 years did. So we just spent a lot of time on the favorite domestic area, right? Actually, favorite equity area, fixed overseas investments, foreign investments. Now we're going to jump to our client's second favorite area, which is fixed income. That's a tongue-in-cheek comment. Again, fixed income has not been all that generous the last couple of years. So Maddie, I'll let you take this slide.
So this is looking at index returns as of December 31st of last year. So you can see that bonds took a very big hit looking at this 1-year picture here. They've picked up a little bit in the last quarter, so we're showing some positive returns for all these different indexes. But what's interesting here is if we look at last year, given how hawkish the Federal Reserve has been, if we look at an equity proxy, given US dividends tend to be more value type stocks, their 1 year down is down 3% versus the US bond aggregate index down 13%. So obviously, as an asset class, bonds were heavily impacted last year, but again, making some turnarounds here in the last quarter.
Yeah, some of that is really that they may have got oversold as we got in the October timeline when we had some panic in the UK gilt market. You saw the 10-year touch, 420, 430. It's come all the way back down to 350. Bonds through yesterday, year to date, we're up 273, right? So you could say, well, in some sense, that was pretty close to 80% of the market's return has come in the first 3 or 4 weeks of the year. The other view out there is that the bonds are telling you, the bond market is telling you that a recession is imminent, and people are wanting to get into fixed income as a store of value or safe haven. I'm not sure I believe that, but again, something worth monitoring. It gets back to the idea like, hey, all things being equal, stocks up 4% year to date, very good, right? Bonds up nearly 3% year to date, outstanding, right? So just important to have fixed income in the portfolio as a diversifier, as much as a source of return. This is, to me, one of the most mind-boggling things of my career. I've been in the business for 22 years, the idea that if you gave someone something and they got back less, it was not an investment, right? It was it's basically something that depreciated or an expense, right? So we had a period of time from the mid 2015, 2016 territory to really the end of this past year, where you had massive amounts of global debt with negative yields, right? 18 trillion at its peak. Now none, right? And so that's healthy. What it means is that we've got back to some sort of normal environment where you actually are compensated for parting ways with your money for some period of time. Still a long ways to go to get back to long-term averages, but the end of zero interest rate or negative interest rates is a welcome change. That whole thing was based on or predicated on the notion of the greater fool, right? That I could buy something, well, I was going to get a negative return and it sell to somebody else at a higher price than I paid for it. Then I was still worthwhile to make that investment. That's a fundamentally flawed argument, and so good riddance to the negative yielding environment. We have seen the bond rally, not just in investment grade, which has been like consensus trade, but in high yield as well. I have concerns with high yield, right? Like if you look historically, high yield tends to start to do better as the economy recovers. So there's a bit of an argument one could make if we have seen the peak in the slowdown. But again, some data suggests that might not be the case. We see deterioration in auto loans, credit cards, mortgages, albeit again modest on the mortgage side, which is just at the consumer level, which eventually will bleed into the corporate level. The high yield bond market was very fortunate for the last 10 years or so to be able to issue paper at very attractive rates. There's no real wall of maturities in the next couple of years, but it'll be interesting to see what happens 3 or 4 years from now. We think that what's created the rally in high yield is nothing to do with credit. It's much more about inventory, right? You can see since the beginning of last year, issuance basically dried up. And when there's no issuance, you're basically, people are fighting for existing inventory, driving prices up. So for all intents and purposes, I would say to you, it's unlikely that high yield continues on its current track unless we had some real Goldilocks phenomenon. And Maddie, I think there's like a pop-up box in the, yeah, sorry, thanks. So where's the value in fixed income right now? So tips are probably as attractive as they've been in a few years, and that seems kind of strange, or at least a couple of years. You kind of want to own tips in a period where inflation expectations are declining, but inflation itself might not decline to those absolute levels, right? So the forward expectations for inflation were as high at one point as 4%. They're just under, and now we've seen that kind of decelerate. So the five-year break even is at around 2.5%, right? So inflation expectations have moderated quite a bit. And I think at this point you'd say, well, is it impossible inflation could run a little bit north of 2.5%? And if so, treasury inflation protected securities aren't a bad bet. If inflation gets significantly below that, the equities you have in your portfolio will probably do well, so long it's not a story with a more deep recession. Kicker bonds are a phenomenon in the municipal space where you have bonds with a relatively short maturity, a very relatively short call date, but their maturities are 7 or 10 or 15 years out. So you can buy these bonds very close to par. And so you're not paying, much over its face value. But if the bonds get past their call dates, the near-term call dates, which is likely because, going to market right now can be a little bit expensive, those bonds end up having attractive yield to maturities. Triple B corporates, that's the place that probably is more attractive today. At one point back in the fall, I was buying paper from the Home Depots and the Oracles of the world, big Fortune 500 companies with yields of 5 to 5.5%. They've come in a little bit, but you still can find some value there. And then preferred stocks, it's a bit of an esoteric asset class, somewhere in the capital structure between debt and equity, but yields there are still between 6 and 7% and can provide some tax advantage if owned outside of a retirement account. So fixed income is a place I'm still very much passionate about. I think it's very much an idiosyncratic market.
And last but not least here, we're going to wrap up with the asset allocation piece of why staying invested is important. And asset allocation drives 90% of your overall return. So certainly something, that you want to get right from a time perspective, but also from a comfortability of volatility perspective. And if we look at asset class returns from 2008 to 2022, this is that Callan chart that, floats around a lot. So I'm sure a lot of you have seen this, but it breaks down the different asset classes here. And as you can see, these white boxes here are a 60-40 portfolio. I know that's been in the news a lot as well, but you can see that it's not capturing the high highs of the market, but it's also not on the participating in the lowest end of the market either. And I think that this does a great summary of between 2008 and 2022 here. So the annual average return is up there on the high end, whereas we look at volatility or how much you're going to participate in that roller coaster that is the market, you're on the lower end. So if we can take less risk and capture more of the upside return of the market, that's exactly what we want to do, right? So no free lunch at investing besides diversification and having the right asset allocation, which is essentially what this chart is showing you. And if we look at that from a return perspective, this is that same 60-40 portfolio from 1950 to 2022. This is the green is looking at an equity return. The gray here is looking at the fixed income return. You can see here that, you've had a lot more up years than down years. And also those bull markets here have lasted longer than those periods of negative declines. So, as there's been a lot of news coverage around, is the 60-40 model dead? It's still alive and well, and we think that there's a lot of value in it.
Yeah, I would take that further too. I think unfortunately, a lot of the data out there is still looking at the 60-40, and so we really get some great science there. The 70-30 is kind of a very similar approach. People living longer today, and asset classes suggest that equity returns will likely be a little bit higher than bonds, at least on the average. So 60-40 and 70-30, we kind of look at that as very much related. It's really the concept of blending asset classes versus being kind of absolute, hey, I'm going to just pick stocks.
And speaking of just stocks, if we look at that from, sort of the same graph there, if we look at stocks and how they've performed in a year. So on average, stocks take a decline during the year of about 10%. So while we've seen, solid intra-year declines, annual performance has actually been managed to be positive most of the time. So this is looking at a 43-year time span. We've been down 8 of the 43 years, which would mean you've been up or you've had a positive return 73% of the time. Of these down periods where the market has had a contraction, you're looking at being down 10% or less. So for 3 of those periods there. So it's pretty significant, a reason to stay invested and know that bull markets last longer than down markets.
Yeah, I think the next slide. We'll skip this one slide. We'll hop to the next slide, Matt. I think the next one does a really good job of kind of providing some, yeah, this one, perfect. To that point, if you look at, duration of bull versus bear markets, right? Bears are 14, right? We get to the point where we kind of exhaust ourselves faster. Bulls tend to be 70 months, right? So if your average bear market's a little over a year, and we've been in one since November of 2021 by some standards, let's call it January 3rd of 2022 by others, you're closer to the historic end of a bear versus the bulls runs, which tend to be something closer to 6-7 years.
And if we go back there, just the 2 slides that we skipped here, sort of making the same case for a diversified bond portfolio as we were making for stocks. Bonds have been up a lot more years than they've been down. This is a period from 1980 to 2022. And while, poor performance in 22 was due to the most aggressive rate cycle in over 40 years, you can see that here. We do anticipate bond portfolios to be positive moving forward. And if we look at expectations of future asset class returns with US large cap stocks, small caps, international large caps, bonds, and cash, you're seeing here that this has been their annualized return since 2000. And this is what we may anticipate moving forward. So we talked about that 6 to 7% range for stocks. We made the case that international stocks are undervalued at this point. They're a bit cheaper, so they should have higher expected returns. Bonds, we think are around the 2 to 3% range. Certainly, hopefully this illustrates that cash is not the place to be. We still want to make money. We still want to be positive. And although these are lower than annualized historical returns, they're still providing value there.
Yeah, look, this is Schwab does this. This forecast was as of 12/31 of 2021. Vanguard does something similar. A lot of companies do these kind of 4-10-year estimates. We use some of this methodology in our planning as well. If you come back and think of, hey, we took 20% off the S&P to just do simple math and to make back up that 2% over the 10 years, you could think maybe equity returns will be higher than the 6.4. Independent of that, 6.4 is 3 times larger than 2 in bonds, or nearly 4 times larger than 1.5 in cash. So it still behooves you to be overweight equity, independent of how well these forecast returns actually manifest themselves. It is safe to assume that the next 10 years probably aren't as good as the last 10, even factoring in the ugly year that was 2022. S&P returns for the last 10 years are still 12-13%, so higher than even that long run average of the last 50 years.
And we'll end that asset allocation piece here. As always, your time in the market is certainly more important than timing the market. This graph is looking at the annualized S&P 500 index total return between 2003 to 2022. So 19 years of data there. Missing, if you were invested that whole time, you would have had an average annual return of about a little less than 10%. If you just missed those top 10 trading days, your return essentially would have been cut in half here. So, certainly, again, making the case that staying invested and having confidence in your investment strategy is the place to be.
Yeah, and look, to expand that too, no one I talk to has an investing time frame of 10 days or a year. If you do it, you're really not investing, you're just kind of preserving capital. Most investors we talk to are, God willing, going to live another 20 or 30 years. And so if you look at equity returns over a rolling, 5, 10, 15, or 20 years, the probability of loss drops markedly. By the time you get to 15 or 20 years, the probability for loss in equities tends to almost diminish to zero, right? So let's not get too caught up in the headlines and the day to day. We're going to do more damage to ourselves missing those top days, than any positive that we could if we just got lucky.
And as we speak to negative headlines, something that certainly has made not as many headlines because we think it's actually a pretty positive thing, but something that we sent out a piece around, the Secure Act 2.0 was passed, and that made significant changes to retirement plans and how people save. These are just a few bullet points from the legislation that was passed. There was over 200 different changes. We think that these are the ones that are most pertinent to the people on this call today. But the required minimum distribution age is going to be increased to 73 starting in this year. In 2033, it's going to be increased to 75. The penalties that will be assessed from the IRS will be decreasing. Right now, they're at 50%. They're going to be coming down to 25%. And if the IRS is in a good mood and you take care of your required minimum distribution in a timely manner, we're still waiting to hear what that exactly means from the IRS. Your penalty will go down to 10%. For employer plans right now, or you used to have to start taking required minimum distributions from Roth accounts. You are no longer have to do that starting next year. Your catch-up contributions will be increased. They increased this year to $7,500. They'll be increasing to $10,000. And then IRAs, the $1,000 catch-up will start to be indexed for inflation. So you'll see that go up. That hasn't happened before, so that's pretty significant. And then after, with 529 plans, we think that this is, one of the most significant pieces here as well. If after 15 years that the 529 has been in place, your beneficiary will be able to roll over $35,000. That's a lifetime limit into a Roth IRA. So tax-free growth there, it'll maintain that wrapper. And you can't roll over $35,000 in 1 year, though. It'll be subject to annual Roth contribution limits. And if you have any questions on how that pertains to your particular situation, please reach out to us and we'll schedule an appointment.
Great. So we talked about legislation that we know, and then we have legislation we don't know. So this is my probably riskiest slide in the whole deck in terms of trying to forecast what the heck happens with Washington and Congress by June or July. All estimates are that's when we bump up against the debt ceiling. And so what's interesting, everyone's going to draw a parallel with 2011, but you have to go back and look at what took place at that time and whether or not the brinksmanship that created some or forced action at the time would be likely to repeat. And so in 2010, the Republicans did very well with the midterms, right? That was a red wave. You saw a 60 seats swing from the Democrats to the Republicans. And so it emboldened the Tea Party and at the time, John Boehner and Eric Cantor, who was his second in command, to really kind of push for government to cut down on their largesse, right? Like specifically introduce the concept of the sequestration. And now they went all the way up to the 11th hour. Maddie and I were joking about, like, if you went to a national park at the time, the trash cans were overflowing, or frankly, you couldn't even get in because the government actually stopped paying federal workers for a very short span of time. They were actually, paid back in a lump sum. But it seems unlikely that it would continue or take that same approach this go around for a couple reasons. One was, at the time, Obama's approval rating, despite the fact not doing particularly well when it came to the House and the midterms, the Democrats held on to the Senate, but his approval rating was in the 50s. And so it was easy to go ahead and put a government shutdown on his lap to the extent that it was something that would knock down his approval rating. President Biden's approval rating is plumbing, the low 40s. On top of that, he's dealing with today the scandal that is, classified documents showing up everywhere, right? So there's probably more downside to the Republicans pushing that and hoping that ends up being a Biden, problem versus their own. The other thing is, the specific piece that they've made reference to, this is the Freedom Caucus, is on government spending. There's only a few places you can make a meaningful impact on government spending. And it's reform of Social Security and Medicare, as well as on defense. Those things are probably not a place you want to spend a ton of time over the course of the next 9-12 months, especially as you kind of start the primary season leading into the 2024. So I would say the debt ceiling is likely to go ahead and get a lot of headlines. Probably not going to be the same market moving event that we saw in 2011, especially with the downgrade. But interestingly enough, like since the debt ceiling has become more of in the public domain the last 2 or 3 weeks, we have seen a rally in treasuries. Whether or not that's related or it just has to do with some natural rebalancing of portfolios or investors looking at relative value and fixed income, that you could argue that despite the fact that the argument with the debt ceiling is the government stops paying debt, that people want to buy more government debt because it's a really safe place to be. Again, a head scratcher for sure. So again, we'll keep you abreast of this. We'll have another quarterly market update likely in April and give you perhaps a bigger or a closer feel to where we stand on this. But for now, I wouldn't put a lot of weight on this, and frankly, I'm not recommending us doing anything with our clients in terms of posturing around this specific issue.
Now, opening it up for questions. Are there any questions that anyone in the audience has here? And I'll stop sharing here so I can actually see them.
So to address questions as well, there's a Q&A button where you can actually type in the text of the question instead of a format where we find ourselves with people kind of talking over one another. The Q&A piece is generally something that we would encourage folks to just type in. If you're uncomfortable asking in that setting, we're happy to have a conversation offline. Feel free to send us an email. And again, we will send out content to folks who want it if they want to review it. Some of the stuff from Charles Schwab is very, very good. We probably scraped about 5 or 10 of their slides. We'll give about 3 or 4 minutes for us to have some Q&A come in, and then if not, we'll let you enjoy your afternoon or late morning.
I don't have anything coming in here just quite yet, but we'll give it another minute or so.
Sure. Folks, in addition to having questions specific to your circumstances, we would welcome feedback, right? To the extent that this format was helpful, if there were things we could have done better, things that we did well that you'd like to see more of, we would accept, or we're willing to take that into account for our future discussions. We will eventually probably start doing surveys attached to the webinar themselves. I anticipate a survey going out to clients later this year for just kind of the general experience period. But again, any thoughts or comments are welcome.
And on that note, we don't have any questions at this moment. So like Jeff said, please feel free to reach out to us if you want to ask us something that pertains to your particular situation or want to ask us a question offline. Oh, we just had one come in. We had a question come in. Are required minimum distributions no longer required in Roth accounts starting in 2024? So that is for employee accounts. So 401ks, 403s, 457. We still have yet to hear exactly what they meant about IRAs.
Yeah, so the assumption is for this point in time, the death of the RMD for Roths exists, right? Like there could be some requirement on inherited Roths, which is I think what Maddie's talking about.
Yes.
But Roth IRAs themselves have not had a minimum required distribution ever. The 401k, 403b piece, fortunately, they kind of came around to that and realized, hey, like, we can't collect any tax revenue on this. Why are we bothering forcing people to take the money out? So for now, and this is a case where, especially for younger people which have that option, we make an argument that to take advantage of the Roth 401k or 403b if you have the capacity to do so. And any other questions?
No other questions have come in. So we are at the top of the hour. We want to respect everyone's time. Thank you so much for joining us. And we'll see you again next quarter.
Have a wonderful Wednesday. Bye, everybody.